Ladies and gentlemen, good day and welcome to the Man Industries India Limited Q3 FY26 earnings conference call hosted by Arihant Capital Markets Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star and zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ronak Oswal from Arihant Capital. Thank you, and over to you, sir.
Thank you. Good evening and welcome everyone. On behalf of Arihant Capital Limited, we invite you to Man Industries India Limited Quarter 3 and 9-month FY26 earnings conference call. From the management side, we have Mr. Dr. Ramesh Chandra Mansukhani, Chairman of the company, Mr. Nikhil Mansukhani, Managing Director, Mr. Sandeep Kumar, Chief Financial Officer, Mr. Rahul Rawat, Company Secretary, and Mr. Vijay Gyan Chandari, DGM Investor Relations. So without any further delay, I will now hand over call to the management for their opening remarks. Over to you, sir.
Yeah, good evening everyone. I warmly welcome you all to our Q3 and 9-month FY26 earnings conference call. Let's start with the key business highlights for the quarter. We are pleased to report the highest ever quarterly EBITDA and PAT margin in the company's history, reflecting our sustained focus on product mix optimization, strong operational discipline, and effective cost management. Export markets continue to perform well, supported by healthy order inflows and inquiries, particularly from MENA region, Southeast Asia, CIS countries, Africa, and Asia Pacific. Exports remain a key growth driver, accounting to 83% of the order book. This underscores the growing global confidence in our technical capabilities, execution track record, and ability to deliver complex, large diameter pipe solutions. Within the export mix, LSAW pipes constitute 80%, which is an increasing contribution from our value-added offerings such as specialized coating and bends. On the domestic front, the early green shootouts are visible with gradual recovery reflected in selective order wins during the quarter from oil and gas companies and EPC players. Additionally, the recent Union Budget announcement on the revival of Jal Jeevan Mission with proposed spending of approximately 67,000 crores is expected to be significantly increase central government's expenditure on drinking water and sanitation in the next fiscal year. However, the pace of execution and grants to states remain key monitorables. Overall, we expect the domestic market to see a meaningful recovery in FY27. As on date, our executable order book stands at approximately 4,000 crores, providing execution visibility over the next 6 to 12 months. With strong momentum continuing in the current quarter, we expect Q4 FY26 to be among the best quarters in the company's history for its core business. Accordingly, we reiterate our original FY26 revenue guidance of 36 to 3,700 crores and upgrade our margin guidance to 13-14% compared to the initial margin guidance of 11 to 12%. Now, coming to the status of our strategic expansions, the company's strategic capacity expansion initiatives in Saudi Arabia and Jammu are progressing well, with key civil works and major equipment installation substantially completed. The Saudi facility is advancing as planned and is expected to be completed by Q1 FY27, and the Jammu facility also remains on track. Both projects will significantly strengthen our geographical reach, capacity, and ability to participate in high-value contracts, ensuring diversified growth in the coming years. With that, I now hand over to our CFO, Mr. Sandeep Kumar Garg, to review the financials. Over to you, Sandeep.
Thank you, sir. Good evening, everyone. I thank you all for joining the discussion for our Q3 and 9 months FY26 financial performance. Let's start with the key financial highlights. First, I will start with the consolidation results. Total income for Q3 FY26 stood at 838.7 crore, a growth of 13.7% YOY basis and 2.9% on Q2Q basis. EBITDA grew by approximately 61.4% YOY to 136 crore, with margin expanding by 480 basis points YOY to 16.2%, the highest ever in our history. Profit after tax grew by 61% YOY to 55 crore. The 9-month performance, total income stood at 2,427 crore, up 4.5% YOY. EBITDA grew by approximately 47% YOY to 318 crore, reflecting sustained margin expansion across product lines. PAT stood at 120 crore, growing approximately 41% YOY, with cash profit increasing by approximately 47% YOY at 175.9 crore. On the balance sheet front, we continue to operate with a strong balance sheet. As on 31st December 2025, we have a net cash position of 38 crore. Overall, these results reflect strength of our business model, execution excellence, and strategic initiatives that are driving sustained profitable growth. Many of you must be thinking about sharp increase in our other expenses YOY and QOQ. The sharp increase in other expenses in Q3 FY26 are primarily driven by higher freight and logistic costs associated with fulfilling a significant portion of company's executed order under DDP, which is Delivered Duty Paid. With this, we would now open the floor for question and answer session. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and one on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Divyansh Thakur from Finterest Capital. Please go ahead.
Good afternoon, sir. Congratulations on a great set of numbers. Sir, you upgraded the EBITDA margin guidance. So, sir, is it the upgrade also applicable for fiscal year 27? Are we going to see 13 to 14% EBITDA margin? Hello.
Yeah, Devansh. Thank you for your question. Yes, we should be trying to sustain in 13 to 14% EBITDA margin for FY27 as well.
At console.
Okay. And sir, any changes to the PAT margin for fiscal year 27 as EBITDA margins have seen?
They will be doing better.
They will increase in line with the
EBITDA.
Okay. Thank you so much, sir.
Thank you. The next question comes from the line of Viraj Mahadevia from Money Growth. Please go ahead.
Hi, congratulations on the fantastic numbers, especially the EBITDA margin update. Just a question regarding your current expansions. How much money is left to be spent between the Jammu and the Saudi facilities as yet?
So approximately 75% is already spent out.
Okay.
The current is around 25%, and then the trials and everything.
So maybe about 400 crores is pending to be spent?
Yes, give or take, around 25% would be 350 to 400 crores.
Understood. And will this all be completed in Q4 or will it spill over to Q1 as well?
Q1 for the Saudi, and Jammu, I think by Q2.
Q2. Okay. So by Q1 and Q2 next year, and all of this will be spent.
Q1 next year for the Saudi and
Understood. And in terms of your current bid pipeline, what is the value of the bid pipeline, excluding the
around
confirmed
8,000 crores currently.
8,500 crores.
7,500.
7,500. Okay, thank you. All the best.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on the touchtone telephone. Participants, to ask a question, you may press star and one on your touchtone telephone. The next question comes from the line of Penil from Choice Institutional Equities. Please go ahead.
Hey, hi. Congratulations for the great result. I want to understand the revenue or cash flow from the real estate segment. So what's the management on the cash flow or the revenue from the real estate segment?
Yeah. So real estate segment, Marino Shelters is now going to launch the project. It's under RERA approvals, and we should be launching it in which we gave to Paradise Group, and they should be launching it sometime in March first week. And this would generate overall top line of around 600 to 700 crores. This will come back into the company over the next 6 to 7 years, and there is no cost or affiliated to this. This is purely the money coming back into the company.
Okay. And what will be the margin from this business?
All is margin.
Or there's no cost to this
So
for the
this
real
was
estate.
600 to 700 crore is all our net profit, I can say.
Yes. Net matlab not PAT, but
But means there will be no any cost, so we can consider like.
correct.
Okay. And what's our any guidance on a consolidated debt, or what's our average cost by end of quarter, and the interest cost, and what will be the range we can expect in the coming period?
The average borrowing cost is around in the range of 8%, between 8 and 8.5.
And the range will sustain or
So it will remain in the same.
Great. That's all from my side. If I'll get anything else, I'll again come in the queue. Thank you.
Thank you. The next question comes from the line of Darshil Javeri from Crown Capital. Please go ahead.
Hello. Good afternoon. Thank you so much for taking my question. Firstly, congratulations on a great set of results. Hopefully, I'm audible.
Yeah, we can hear you.
Yeah. Hi. So just wanted to know, like, in terms of, our FY27, what is the guidance, that we can expect, like, because Jammu is operating partially and Saudi is also operating partially, right? So what can that, contribution be like?
Darshan, we would be looking at approximately 25 to 30% growth in FY27 from FY26.
Okay, fair enough, sir. And so just margins I wanted to ask, because, in the last 2 quarters we have done nearly 15% margin. So we are still guiding for, like a bit lower than that, right? 13 to 14%. So just wanted to know, like, are we being conservative, or, we feel that there are some one-offs in these, that because of some project that, we were able to churn the higher percentage. So going forward, we'll be able to, I don't know, is this 15% also sustainable? Because we've done it, in 2 quarters. Just wanted to ask about that, sir.
Yeah, see, looking at the console levels, and currently the order book and also Saudi, the way it is, the order book in Saudi, which looks positive, we feel that the console level, the EBITDA levels, we'll be able to manage between 13 and 15%. And we rather be a little conservative and overperform, right? Everyone likes that. So we rather be in the range of 11 to 13% and then try and deliver above 13. But I think this is sustainable level currently for us.
Okay, fair enough. Yeah, that's good to know, sir. And so just wanted to know, sir, like next year both of these projects will come online. So will we, have a higher depreciation, right? That cost we know, but what about the finance cost? Because we would be capitalizing some amount of finance cost, right? As the plant is, still underway. So could you just, quantify that, sir? What would be our expected finance cost?
The finance cost at the console, that's why you can see a difference between standalone and console, because the interest is being consolidated. That is why the numbers, the standalone numbers are higher. As regards to, what was your second question on that? Sorry, Darshan?
No, yeah, so what I had thought of was that till the plant is not commercialized, we don't, put it in P&L. Correct me if I'm wrong. I thought that would, be going into some capital work in progress and not in our, balance sheet, in a P&L. So just wanted to confirm that. So we account for all the extra finance cost in our P&L right now, or is it in balance sheet? Because I thought that in FY27 it would come in our P&L. Yeah.
Practically, till the project get a COD, all the costs are capitalized, and after the COD will happen, it will go to the P&L.
Yeah, so that's what I'm saying. So there'll be additional costs happening in FY27, right? So what would that be?
The cost will increase depending on the loans.
Okay, maybe take it just offline. Yeah, that's it from my side. Thank you.
Thank you. Ladies and gentlemen, a reminder to all participants, anyone who wishes to ask a question may press star and one on a touchtone telephone. The next question comes from the line of Satyan Wadhwa from Profusion Investment Advisor. Please go ahead.
Okay. Okay, perfect. Okay. So if you need my help on anything, I'm around.
Mr. Satyam, you may proceed with your question. As there is no response from the current participant, we move towards the next question. The next question comes from the line of Rohan Baranwal from Trinetra Investment Capital. Please go ahead.
Hello, sir. Can you please confirm the target completion for the Saudi Daman plant? And also, what would be the timelines for trial and the first year utilization assumption for the same, sir?
So we would be completing in Q1 with the trials as well in Q1 27. And we are looking at around 50 to 60% utilization in the year one.
And on the number side, sir, can you quantify what would be the revenue recognition that you would be doing for the first year, like operational of the plant, sir?
1,500 and 2,000 crores. Yeah. Looking, depending on the steel price and everything, it will be between 1,500 and 2,000 crores.
Got it, sir. And sir, can you provide us some details on the working capital side, like what kind of incremental funding we would need on the inventory side or on the compared to the measures you've taken right now, sir?
Majorly it's from the non-fund based side, and that would be approximately between the peak load, if we are executing 1,500 to 2,000 crores, would be around 750 to 900 crores of non-fund based, basically for LCs and BGs.
Got it, sir. Thank you very much. That's it from my side, sir.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on the touchtone telephone. The next question comes from the line of Harsh Jain, an individual investor. The next question comes from the line of Satyan Wadhwa from Profusion Investment Advisor. Please go ahead.
Hi, very encouraging to hear margins are going to be higher. Just wanted to know what would be your expected revenue from Saudi and Jammu in FY28 when they're both operating, at maybe 75-80% utilization. What should we be expecting from that?
So for FY28, you would be Saudi. We would be doing anywhere between 2,000 to 2,500 crores.
Right. And Jammu?
Jammu we would be at around 500 plus crores, 5 to 600 crores.
Okay, great. And margins in Jammu should be around 17-18%, right?
Yes.
And how does, if you don't mind answering, how does the whole sort of duty drawback or GST benefit work? So do you charge GST but not book it as a cost?
No. You book it and then you do all of it, and then one second, CFO will explain.
GST is never a cost because whatever GST paid on the input are taken as an input. Whatever we buy, GST input is available, and
right.
Is available for export also. And for export, we get refund of the GST based on the exports. What about in you're talking about Jammu or our five business?
In Jammu, you get GST benefit for 3 times your capital expenditure, right? So that I assume would be on about 450 to 500 crores extra land Is that correct? In your presentation, you said, right, 3x of investment in plant and machinery would be paid back in 10 years tenure in the form of GST credit. So,
Pay the GST.
understand the mechanism of how this gets paid back.
Incentive.
No, we have to pay the GST, recover and pay the GST, and then we have to apply with that documents to the government for a grant to get it repaid. So
Okay, so this will come, I guess, back to you like a year in arrears, right? Like after a year, it'll start to come back after your first year or so.
Correct. So we have to account for it, we have to pay the tax for it, and then we make this and we send it to the government, and you get it every quarter. So, yeah.
Okay, perfect. And the second question, on this was the 6% as a subsidy on interest. So do you, like, say if it's 9% interest rate, do you get 6 back? So it's net free, or is it only 6% interest that you have to pay?
3.5, give or take, yes.
Okay, so you get a 6% subsidy. So you only pay 3% on a 9% sort of interest rate, right? Is
on
that
the
correct?
borrowing. On the borrowing. Nice, yes.
Okay, perfect. And okay, so you can run this for the next 5-7 years if you wanted to, in terms of just cheap money, right? So just trying to understand like housekeeping. Okay.
Make the arbitrage on it, yes.
Yeah. Okay. Perfect. Great. Thank you, and all the best.
Thank you.
Thank you. The next question comes from the line of Karan Mohanpal from Capri Global Capital. Please go ahead.
Hi, sir. This is Riken here from Capri Global Family Office. First of all, congratulations on good performance as well as consistency on the margin front. Sir, firstly, I wanted to understand, you've sort of indicated that you will be able to maintain your full year guidance for this year, which does imply almost a 40% bare minimum kind of a growth that you see. So is it in the quarter 4, is it that you are seeing some large export order execution which is driving the kind of growth in quarter 4, or what is it that is driving the growth in quarter 4, if you can help understand?
It is obviously execution of the existing orders in hand, and most of them are for exports. And plus these orders also which we got were always taken at a better margin, and our execution has been very, very good. So we are trying to save certain percentage, and that all is reflecting in the EBITDA.
Got it. So from here, so that is the first question. Second question is in terms of your margin trajectory from here on. If you could outline 1 or 2 headwinds and tailwinds that you see in going into the next year.
So, currently with the order book and Saudi coming operational, we see we'll be able to maintain between this 13 to 15% EBITDA. We don't find any challenge in doing that. But looking at the commodities and the way commodities have really run up, going forward, every order cannot be, but I think it is safe to say for now that we'll be at a 13 to 15% EBITDA, which is somewhere where we were working on in the last few years, and we should be consistently able to achieve that.
Got it, sir. And lastly, if you could, not related to the quarter's numbers, but you did indicate some kind of a partnership with, or approval with Aramco in your press release some time back. If you could outline what kind of opportunities can this offer us in the longer run?
Yeah, so this opportunities with Aramco, with the current oil and gas business, which the plant is being put up, so there is an offtake agreement which would be in place once the plant is up, early approvals and preference of being the local player to get more business. And in the long term also there are a lot of other products which they are very, very keen, and we are developing together. And maybe in the long run we get the opportunity to set up something specifically for Aramco, and they would again have an offtake with us. So it's quite premature for me to tell exactly what it is, but we are working on it. It's pretty much work in progress, but it would give a big advantage to the company of being present there first, preference of moving and getting a margins in place.
Just a follow-up, does the domestic India business also benefit in any form from this kind of tie-ups?
Not really. Not really.
Okay. Okay. Got it. That's it from my side. Thank you so much and all the best. Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on your touchtone telephone. The next question comes from the line of Viraj Mahadevia from MoneyGrow. Please go ahead.
Hi, Raj here again. In the past, you indicated a top-line potential of 6,500 crores for FY27. Assuming you're sticking to your guidance for the press release of 3,700 crores and a growth of 30%, that would imply a top line of about 4,800 crores for 27. Can you clarify on that, please?
Viraj, I think
Yeah.
he will be able to achieve of 5,500, 6,000 crores in FY27, and those were the guidelines. But again, please understand that the guidelines of the turnover, particularly the numbers, cannot be held on to like tight, because the steel prices and commodity prices have really fluctuated over the last year and a half. And we have to look at the overall outlook and also the production numbers as well. So give or take, if the prices of steel remain where they are, we will be able to achieve more than 50-55% growth. On a conservative level, 30-35% growth is like conservative and realistic. But our internal goal is at 50-55%, which our budgets and everything is set at.
That's good. Much appreciated. Thanks a lot.
Thank you.
Thank you. The next question comes from the line of Disha from Sapphire Capital. Please go ahead.
Hello.
Yes,
Hello. Hi, sir. Am I audible?
question.
Yes.
Yes, congratulations. Good set of results, sir. So I think you mentioned you have a 4,000 CR order book currently. What's the sort of exit rate for this year are we targeting? And I think you mentioned we have a bid pipeline of 10,500 crores. So what will be the win ratio?
So bid is 11,500, not 7,500, 11,500. The bid ratio is 20-30% is the average strike of the bids. Currently, the order book is 4,000 crores. This year, we would be as committed, we would be growing around 20-25% standalone from last year. Last year, standalone was 3,130 without Merino. And so this year, we would be growing around 20-25% on the standalone basis. Yeah, anything else, Disha?
Yeah, and this Saudi and Jammu plant at optimal utilization, what sort of revenues are we targeting?
So yeah, now when it comes to the absolute optimization at around 75-85% peak, which we can achieve approximately from Jammu and Saudi put together around 4,500 crores. Maybe even 5,000 crores.
Okay, all right. Thank you so much, sir. That is from my side. All the best.
Thank you. The next question comes from the line of Sandeep Mathivanan from MoneyGrow Asset. Please go ahead.
Okay, thanks for the opportunity. The question is related to a bit like margin expansion which took place in this quarter. So is the improvement primarily driven by change in product mix, or is it some temporary effect due to increase in commodity price? Thank you.
No, it's not this. It is basically value addition in the products, the businesses that we've taken, and also the internal systems which we have improved, which is overall giving us the betterment in the EBITDA.
Okay, so sir, if you have the data, can you share like what percentage of the growth is driven by pricing and what percentage is driven by volume?
Sorry, pricing and what percentage by?
Volume.
Sorry, your voice is cracking.
What percentage of projected growth is driven by pricing and volume?
And volume. Okay,
Yeah.
We can share the data with you.
Okay.
Thank you. The next question comes from the line of Nikhil Singh from Equivision Consulting. Please go ahead.
Hello.
Hi.
Hello. Thank you for taking my question. So you have been guiding a 25% growth, 20 to 25% growth from the year start. But when I see your quarter numbers, I don't see that kind of growth in Q1, Q2, Q3. So what makes you so confident that you would be able to achieve those numbers in Q4?
We have a confirm order, we have a shipment schedule. The Q4, we are going to achieve a higher number, which will help us reaching our guided figure.
Also, Nikhil, one very important thing, our business cannot be looked on quarter and quarter. Our business is always looked at a holistic basis. And like we just said, that we are already in almost midst of Feb, and we are very confident is because we have our shipments lined out. Our production is already ongoing, and quite a lot of it's already done. And we are shipping those products out. So we are more than confident to achieve the guidelines which are given by us.
Okay. One more question on your Saudi plant. As you have said that you would do around 2,000 crores from Saudi plant in FY27. What are your plans for FY28 and beyond? Since Saudi is seeing a lot of demand for line pipes in their energy transition and their desalination plants. So what are your plans on expanding those Saudi plants beyond FY27?
So FY27 guidance was between 1,500 to 2,000 crores. FY28 is between 2,000 to 2,500 crores. And we are confident between FY29 it would probably go around 2,500 to 3,000 crores. So these are obviously, like we said, these are our expectation and estimation. Some orders which are in line pipe, which negotiations are going on, some Aramco orders which will come by FY27 second half. So, you know, these are expected numbers. If there are some big order and we get it and we are able to churn it around, even the numbers can go up. Also, these numbers are in, fluctuating around almost 15-20% depending on the commodities price. So that's what we are expecting.
Okay. Thank you. Thank you so much for answering my questions. That's it from my side.
Thank you. The next question comes from the line of Divyansh Thakur from Finterest Capital. Please go ahead.
Sir, thanks for taking my question again. Sir, so I wanted to ask that in the last call also you mentioned that, from the Jammu plant it will be around 500 crores in the fiscal year 27. So are we not going to see a ramp up in fiscal year 28? And you also gave a guidance of around 7,000 crores of revenue. Would you like to revise that or something? Thank you so much.
No, see, guidance and steel doesn't work on me. Our guidance as per the top line we will be able to achieve by 2028. But also the commodity prices also depend on that, right? So if the commodity prices are up 20-25%, it will be easier for us to achieve those guidelines versus if the commodity prices drop, obviously the volume has to go much, much higher to achieve the same numbers. So this is an expected guideline of what, currently we are expecting the steel to be at and everything, and the commodities to be at.
Okay, sir. Thank you so much, and all the best.
Thank you. The next question comes from the line of Viraj Mahadevia from MoneyGrow. Please go ahead.
Hi, Nikhil. Quick question. Would you be able to give us a sense of the funds coming in from Merino, the real estate, over the next few years? Is it more back-ended towards 2029, 30, or will we see some of it come earlier? And also, will those funds be prioritized for debt pay down? And when do you think you become net debt free without any further expansion?
So the first I will answer by Merino. The Merino revenues will start in FY27 itself. We're expecting between 70 to 100 crores FY27. And this will continue for around 6 to 7 years approximately. The total revenue will be between 600 to 800 crores. There is no expense out, so this is all income which is coming into the company. This all money and the free cash flows will be used for reducing the debt portions in the company. And we see by 2030 the numbers of debt are dramatically down. Some debt we won't pay on purpose because of the Jammu with the 6% interest benefit. We would pay it down as per the dates given and not prepay it. But the rest of the debt we would like to use our free cash flow and everything for repaying the debt, and some other, if capex planned out at a later stage, we will keep you posted.
Okay, great. Thank you.
Thank you. The next question comes from the line of Darshil Zaveri from Crown Capital. Please go ahead.
Hello. Thank you so much for taking my question again. So sorry, this might be a bit of a repeated question, but I'm just having some, problems, reconciling the numbers. So if we are saying in the standalone business, we'll have around 20-25% growth, right? So that would, maybe take us from 3,600 to 4,500 on the upper end. Jammu, we are thinking of around 500 crores.
I said 25-30% growth on FY27 on consolidated numbers.
Okay,
and I
so
said
that
internal guideline is 50% with what we are seeing the numbers currently with the Saudi and everything. But 25-30% is just a guideline that we are saying, but internal numbers are 50%, which is on consolidated level, which is Saudi, which is India, and which is partially for Jammu as well for some quarters.
okay, so I get it. So 25, because Saudi itself would be around 1,500 crores, right? That's what we are targeting. I'm not saying it's a guidance that, will be firmly holding, but around 1,500 crores is the target that, we have from Jammu itself, from Saudi itself, right? So that itself would, increase our revenue by more than 30%, right? Without like even any growth in standalone or Jammu coming into play. So that's why I just wanted to, ask about that, sir. So standalone, I'm assuming we'll have some growth, and Jammu is again a target. I not want to catch hold of it, just for our purposes that maybe this is the potential that we can reach. So so Saudi is around 1,500. So Jammu from FY27, what are we expecting, sir?
We are expecting approximately 300 crores.
300 crores, right? Yeah. Oh, okay. Fair enough, sir. Yeah, that's it from my side. Thank you so much.
Thank you. The next question comes from the line of Puneet Chokhani from an individual investor. Please go ahead.
Hi, thank you for taking my question. I actually had two questions. One, when you say 2,000 crores of revenue coming from Saudi, what percentage utilization are you factoring in? And second question is if you can throw some light on how large is the Saudi market in terms of tonnage. Potentially just want to get a sense of how large can a business like this be, say, 5 years from now. Thanks.
So the consumption is almost 50% at a 1,500 to 2,000 crores. It's at approximately of a 50 to 55% level in Saudi. And the Saudi market, looking at the current Saudi market and our current capacity, we would be able to probably, if the market is very good, and with the value-added business of coating and everything, we would be maybe able to scale it up to approximately 4,500 to 5,000 crores.
Okay, this is based on the commitments that you have as on date and what you see in terms of order pipeline, right? I just want to get a sense. I mean, sorry, please go on.
Doesn't happen as per that, it's basically you have to see what kind of size, thickness of pipes comes. A lot of times there is a single size and you run it across the year, then you get a much better yield and output, versus if you do multiple sizes, your tonnage drops. So your consumption is high, but your revenue is not, because you're not able to remove the same kind of tonnage which you would have removed on a different size. So it's all variable. But that's what we do, that we see which best works for the size and output and also value, right? You want to get the best price and best EBITDA out also out of certain businesses.
Of course. Okay. Just one more question. in relation to Molino Shelters, which is the real estate business. You said about 600-700 crores is what you expect to get over the next 3-4 years, right? How much percentage share is that of the total revenue that's collected by your partner?
30% of the revenue which is going to come in of the total revenue is to Man Industries, Reno basically.
So 600-700 crores is 30% of total collection, just to understand that, right?
600-700 crores is the 30% to the total collection.
Yes. Okay, fair. Thank you. That's all from us. Thank you.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on a touchtone telephone. Participants who wish to ask a question may press star and one on the touchtone telephone. The next question comes from the line of Jimit Mehta, an individual investor. Please go ahead. Mr. Mehta, you may proceed with your question. As there is no response, yes, you may proceed.
Hi, sorry. My first question is the revenue margin.
Sorry to interrupt you. No, you're not audible, Mr. Mehta. You may reconnect and join the queue. The next question comes from the line of Harsh Jain, an individual investor. Please go ahead.
Hello, am I audible?
Yes.
Good afternoon. So my question is on the line of the delay of the work. So why there is a delay in both the plants, Jammu as well as Saudi Arabia? So I think it would be operational in Q4, but now it will be in Q2 of FY27. So can you please give me an update on that?
Yeah, so Saudi is pretty much on time. We are already doing the trials and everything. That's why we are confident of Q1 production. Jammu is slightly delayed due to the war and the natural calamities of the flooding and everything which happened this year. So due to that, a lot of the power, everyone came back, and then it took us quite a bit of time to restart and rebuild all the activities. And that's the main reason why it is running slightly delayed.
Okay, sir. Understood. Okay, so also now your bid book is around 10,500 or 11,500. So earlier it was around 15,000 crores. So there is a lot of discrepancies. Can you throw me a light on this?
These are bid books. Basically, we keep bidding a lot of projects, and the bid book actually changes very, very often. Like we might be bidding hundreds of projects, and when the bids go away, certain we get, certain someone else gets, certain we don't qualify. So when we say bid book is also, if for taxation or duty reasons we are not able to supply in that reason, all those put together go into the bid book. So that's why it is varying, and actually if you see next month also it will vary because every month we are bidding so many projects worldwide.
Yes. Okay, that's my side. Thanks.
Thank you. A reminder to all participants, anyone who wishes to ask a question may press star and one on the touchtone telephone. As there are no further questions from the participants, I now hand the conference over to the management for closing comments. Thank you, and over to you, sir.
Thank you everyone for the conference.
Showing faith in our. I thank all the participants in attending the call and showing confidence in our business and our results. Thank you very much.
Thank you.
Thank you. On behalf of Arihant Capital Markets Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.